Hello, everyone. Thank you so much for joining us again today for Safe Money Radio. You might be listening on the radio. You might also be watching online, but I want to say this today. If you are listening on the radio, you've got to go to the podcast online. Go to YouTube and you want to watch this because my all-time favorite guest, I've had him on the show more than anyone else, good friend Ed Slott is with us on the show today. Ed, thank you so much for joining us.
Always great to be here and share great information that always helps people keep more of their hard-earned money.
Hey, guys, if you're listening for the first time ever and you don't know who Ed Slott is, it's because you've been sleeping under a rock somewhere. But we're glad that you're out from under the rock and you're with us today. So, I'm just going to jump right in. This is my most exciting episode ever, having Ed on the show. And I love having Ed on, but here's why I'm excited. So we're going to put this up throughout the show today, but I'm going to block out my ugly mug here for those of you who are watching online. We'll get the camera here it'll finally link in here in a second. But his brand new book, it's not even out yet. You actually have to pre-order it online. We're going to be talking about this, but Ed's new book, The Retirement Savings Time Bomb Ticks Louder: How to Avoid Unnecessary Tax Landmines, Diffuse the Latest Threats to Your Retirement Savings, and Ignite Your Financial Freedom. And this is from America's IRA expert, and according to the Wall Street Journal, the best source of IRA advice. So, Ed, I want you to, if you will, just talk about how rare of an opportunity it is that I even get to hold this book in my hand right now.
Well, you obviously you're a member of our elite IRA advisor group, which is a study group. The reason it's an advanced educational group where you learn about the tax planning, which about 99% of financial advisors avoid. They don't want to talk about tax planning. Yeah, they might be good in helping you make money. But when most of your money is in an IRA or a 401k, it's what you keep that counts after taxes. So if you're listening or watching and saying, Ed, are you saying, 99% of advisors don't do it? No, it's true. Ed, are you saying only 1% of advisors know anything about it? No, I exaggerated. It's much less. Because most financial advisors don't have the insights and that Brad and members of our elite IRA advisor planning group do, that they understand it's about taxes. And I think, Brad, more consumers, people with 401ks and 403bs and IRAs are realizing, I'm going to have to pay taxes on this money. So what if I have 100,000 or 300 or even $1 million? I'm still partners with Uncle Sam, and I don't want to be partners with Uncle Sam. Who does? There's no gain in that. So you're in the right place, and that's why you have an advanced copy, because at our last workshop, and as a member of this group, Brad attends several workshops a year, gets updated. It's not like when an advisor says, I went to an online course, I was looking at comic books while the guy was talking or whatever, but it's not like one of those. This is serious ongoing education, because these rules, two things about the rules surrounding retirement accounts. They're among the most complex in the entire tax code.
Yes.
But the real bad part is, or scary part is, that there's not a lot of room for error. For the most part, they're unforgiving. You make one mistake, you can almost always say goodbye to your retirement savings or big chunks of it. And there's a line I have on the back of the book, Brad, if you see here. If you look at the back of the book, it says, unlike losses in the stock market, money lost to taxes never recovers. So you could have money in the market, it goes down, it goes up, but you say, eventually it'll go up. When you hand over money to Uncle Sam, that's a one-way street. It's like giving money to your kids. It'll never come back. Everybody says, well, I'm just loaning my kids money. No, there is no such thing, just on the side, as a loan to your kids. That money's never coming back, just like tax money. Once it's out of your hands and it goes to the government, it's never coming back. So why not plan to stop that from happening in the first place, so you can keep more of your hard-earned money? Most financial advisors do not train in the tax planning. Actually, I joke around, as Brad has heard me over, for most advisors, like kryptonite. Oh, I don't want to touch tax planning. They even put it on their card. Oh, I don't do tax planning. No, don't say the words. I'll get sued. I'll do this. I have to put a disclaimer on. I know
Yes.
nothing, nothing about taxes. Well,
Yeah.
I would tell you that any advisor that touches an IRA is doing tax planning. They're just not educated, not doing it
Good or
right.
bad, they're doing it. That's right. Yeah.
So that's why this book, this is why, for Brad's question, why does he have the book and nobody else does? Because we gave it out at our training program in May, advanced copies for all of our 500 members there who really study this on a full-time basis. And Brad has been doing this for over 10 years. Can you imagine how many advisors can say they actively take time, weeks a year out of their schedule just to take training in helping people navigate these complex tax rules that affect everyone with an IRA?
Absolutely, Ed. This is actually the beginning of my 15th year. I
Wow.
went to a 2-day with you, a 2-day training in 2009, joined the group in 2010. So this is the start of the 15th year. And I want to say this to everyone that's listening right now, and why I'm going to flash the book all throughout the show, why you want to pre-order, why you want to get your copy of the Retirement Savings Time Bomb Ticks Louder. Here's a great example, a real life example, which I love sharing on the show, of something that happened yesterday. We had a client, 72 years old, called our office. I was in the middle of client meetings. When I came out from my second meeting, Lisa said, "Brad, you need to call one of our clients. She's in a panic." I said, "Okay." I called and I said, "Hey, what's going on?" She said, "Can I come to the office today?" And I said, "Well, I've got a window of about 30 minutes and then I have other client meetings." She says, "I'm coming right now." She lives close by. She came over. I said, "What's going on?" She said, "Well, as you know, I have an inherited IRA from my mom, and I'm going to have to liquidate it all this year, the rest of it." And I said, "Why are you going to have to do that?" And she said, "Well, she died in 2014 and it's 2024. And I was reading online last night that if you're a non-spouse beneficiary, you have to liquidate that in 10 years, or it's, all the issues that come with it." And I go, "Okay, great." I was really worried. Just take a deep breath for a
Yeah, I
minute.
was going to say, take a breath.
It's okay. That was 2014 rules. We now have newer rules that are updated, which is why you want the book, because you can see up here on the sticker, it includes updates for the Secure Act 2.0. So that led us into a discussion about the Secure Act and Secure Act 2.0 and how there is a 10-year rule for new inherited IRA owners, but not for those it's a different rule for those pre-Secure Act. And so she was able to take a big, deep breath. She was trying to do all this tax planning, thinking, I'm about to have all the rest of this taxable income come into my hands this year, and I
Can you
don't have a plan.
imagine?
So
It would have been the end of our inherited IRA for no reason at all. See, that's exactly what I'm talking about. The average advisor will say, oh, yeah, I'll just liquidate it, put it in a stock account, watch it grow, whatever. Watch what grow?
exactly.
After taxes, you can watch it grow for the government.
100%. So, friends, if you're listening right now, I'll always just give you a quick phone number. I want you to have it so that you can always contact us. It's 866-780-SAFE. That's 866-780-7233. But the key thing is, all throughout today's show, you need to pre-order Ed's book. Just go to Amazon and pre-order. It's going to release on June the 11th. So if you're listening to this, this show is going to air for the first time on the radio June 8th and 9th. And so you can go on and pre-order. If you hear it after that, then great. You can get it anytime. Just go on and order it and have it shipped straight to you. But you want to know this information. And we're going to be talking about it all throughout today's show, the information inside the book. So call us anytime at 866-780-7233. Friends, if you're just now joining us on the show, I have America's IRA expert and my great friend, Ed Slott, CPA from New York, just the brightest mind there is. When everyone asks me, they're like, Brad, how in the world do you know all this stuff? And I'll give you a quick disclaimer here. The month of May, normally for advisors, for financial professionals, it's kind of a slow month. It's after tax time. No one wants to think about money. They're going on vacations. There's graduations. Let me tell you quickly about my month of May. I had a grandchild born. Immediately after she was born, she wasn't breathing. We had to airlift her to an emergency hospital in Kansas City. And so that was a 3-day ordeal, terrifying. She's doing great. A
Oh,
few days after that, my son went into the ER and had emergency gallbladder removal surgery.
oh,
I purchased a new home, which I didn't think I would ever do again, vowed to never do again, but I did in the month of May. So had a grandchild born, had a son have surgery, bought a home. And in the middle of all that, I set the all-time record in my business for rollovers in 30 days. Today is May the 30th as we're recording this. I did over $10 million in rollovers and new accounts. Why do I say that? Well, that is a lot. A matter of fact, a majority of tax-deferred money that people contacted us about saying, hey, we want your help. We want your guidance. We know you know this stuff better than anyone else. And they always ask, how did you learn all this stuff? And I said, by studying with this guy right here, the cover of this book, constantly being connected to his classes, his online webinars, going to the trainings. I don't just go to our two-day advisor trainings. I also go to the free events that we can go to as group members at least once a year, because I want to constantly be digging deeper into all this, reading the Ed Slott reports, all the stuff that happens with Heather Schreiber's Social Security newsletter, just keeping my brain filled with all this information. And so you want to be tapped into this type of information that's going to be in this new book, and then also to the type of people who constantly train and study it, because you can't keep up with it. It's exhausting for us to keep up with it all, which is why it seems like every 6 months,
right.
Ed, we have to go through your books are this thick.
And that's all new stuff each 6 months. I mean, when we finished putting this manual, this is the last one. I have it here somewhere. Yeah. Oh, there it is. Yeah, this is the May manual, the one you just went. I mean, it's almost 300 pages of what's new since our last program. This is what Brad is talking about. What we go through this in 2 days, over 300 pages, and that's not all. That's Brad. You just mentioned. I don't even have where that is. I got too many books here.
So many different books.
Yeah. Here's the. Brad also goes, now this is 400 pages, to our 2-day program a couple of times a year. How many advisors do you know that puts that much of an emphasis and investment on their professional education? So that's almost none of them do. I mean, really, if you think about it. So, and there's so much changing. Remember, and that's not. I was going to say it's not anybody's fault, but it is somebody's fault. Congress and IRS. I mean, it's like changing the rules. Personally, I think it's a horror show that it's so hard. You spend a lifetime of savings and they make it so hard to take your own money out of your IRA or 401k or to roll it over. We've seen these horror stories, Brad. We had a few at the last meeting where people, they just try to move from one account to another, but they didn't know the 3 rollover rules and broke them. And in one case, it cost the family $1 million of taxes and penalties. And that's with their fancy Beverly Hills attorneys they had working on it, and their accountants and their financial advisors. Meanwhile, they broke every rollover rule. We actually use that case in our training of what not to do. Here's all the things never to do, because these guys did all of them. I mean, this is bizarre.
Well, think about just this one thing. In the first segment of the show today, we talked about a client of mine that called in and wanted help with a situation. She thought her inherited IRA needed to be completely liquidated. But here's the thing. During that same meeting, she said, hey, I got my letter about my RMD, and so I guess I need to take that out, because they sent me my amount. And I said, wait a second. You're only 72, right? She said, yes.
They sent the wrong letters.
Yeah, so you don't turn 73 until next April. So you don't have to take an RMD this year. And she said, but the custodian of my account, they sent me an RMD letter and it has an amount on there. And I said, well, they may have done it, but it doesn't matter. You don't have to take your required minimum distribution until next year when you turn 73. And that spun us off into the hole. Well, there was a 70 and a half rule, and is. There's a 72 rule. There's a 73 rule. And for everyone born in 1960 or later, there's an age 75 rule. So all of these confusing required minimum distribution rules, You got to be
Yeah,
working
why
with
should it be
someone who
so
keeps up with
hard
it.
to take your money out? But it is. And if you don't have professional guidance, this is where the penalties are horrendous. I mean, they're
Yes.
draconian, even though some of the penalties were softened a little under Secure 2.0 and Secure Act, but still, it's a tough situation.
It is, and that's why you need to order this book. Pre-order it. It's got all the information in there. When we get into our next few segments, we're going to jump into different parts of the book. We want to talk about it, but Ed's brand new book, The Retirement Savings Time Bomb Ticks Louder, is going to be released on June the 11th. So you want to pre-order now, go to Amazon, make sure you get a copy because you want to know things that no one else knows. When they're complaining about a tax they had to pay or a deadline or a fee or a penalty or whatever, you don't ever want to pay unnecessary fees and taxes. We talk about it on the show all the time. The number one thing that will separate you from the retirement of your dreams, I steal from Ed. Ed, what is it?
Taxes are the single biggest factor that will separate you from your retirement dreams, just as you said. People worry about, like I said before, with the stock losses and things. Oh, I made 3% or 5%, or I lost 3% or 10%. What if you lost 40 or 50%? People scream about, the market went up and down, but even on bad days, it goes up and down 1, 2%. But if you lose 30, 40, 50% of your retirement savings, which people do, that I think is a big deal, but people miss that.
Yes, absolutely. We want to keep you from paying unnecessary taxes and fees. Once you do, you pay a tax or a fee, it's gone forever. You don't get it back. So call us anytime at 866-780-SAFE. That's 866-780-7233. I'll send you a free copy of my book, Bulletproof, The Safe and Secure Retirement Income Plan. Ed wrote the foreword to the book, and we will always keep you in touch with the key planning information that will teach you how to protect your life savings. 866-780-7233. Now, friends, if you're just now joining us on the show, if you're listening on the radio, I want you to know you can go watch this entire episode on YouTube. Ed Slott, America's IRA expert, is joining us on the show. You'll be able to watch it. You'll be able to see the things we're talking about. But I want to start this segment by reading something out of the front cover of the book. It says, whether your retirement dreams are 5 years away or 50, the single greatest threat standing in your way is taxes. Unlike losses experienced in the stock market, money lost to taxes never recovers. With untaxed retirement accounts likely to become your largest asset, you face an explosive landscape of costly tax traps, penalties, and a complex maze of rules when the time comes to tap into those savings. So, Ed, in talking about your brand new book that's coming out on June the 11th, tell us about the broken promise. You mentioned the broken promise in the book. What is that?
Well, they told us, and we all fell for it, of course. They said, well, you get a deduction, you put money in your 401k or IRA, you get a deduction, and then you'll take it out in retirement when you'll be in a lower bracket. But that's not happening. And a lot of people actually still say that to me. I talk about Roth conversions and say, why? I'll be in a lower bracket in retirement. But they forget that all those years that they've been working, building, saving, and investing, their retirement account has been increasing. And
Yes.
it's been compounding and accumulating, but also accumulating for your partner, Uncle Sam.
Mm-hmm.
And that money is
Yes.
going to be heavily taxed in retirement. Right now is the time to strike. I mean, right now. We have a 2-year window before rates are supposed to get jacked back up, but it could even be before then. I look as an accountant, that's my training, a CPA. I was taught to believe in math, okay? And
Math doesn't lie.
right, numbers are numbers. I look at as of this recording, a $34 trillion debt. Probably by the time you see it, if you're watching the recording, it could be 40 trillion. Who knows?
That's
Uh,
right.
I believe in math. The whole country is running on a credit card. When will the bill be paid? Congress been kicking the can down the road. Maybe I'm wrong. Maybe they'll never pay it. But you know who's going to be caught in the soup if Congress ever gets their act together and decides we need to pay some bills? It's
Yeah.
going to be the people with the most money tied up in IRAs and 401ks, and they are going to break that promise, and you'll
Yeah.
be taxed into oblivion. That's my feeling, that that day is coming. I call it Judgment Day, Tax Day. Yes, we played by the rules. You did everything right. That was the plan. But when the government needs money, all the plans go out the window. So you have to be proactive and get your plan so you don't end up with a government plan.
And the government's plan for your retirement is what?
Oh, I'm glad you asked that. I say that, that's one of my lines in every seminar I do. You want your plan, not the government plan. I say that, I've been saying it for 30 years. Your plan, not the government plan. Every now and then, I think it even happened in your seminar. I don't remember. We did one in Springfield, right? In Springfield?
Yeah, that's
and
right.
somebody will ask me, oh, Ed, you keep saying your plan, not the government plan. What is the government plan? Maybe I'm interested. No, you're not interested in the government plan. But if you absolutely must know what it is, it's very simple. Do absolutely nothing. And let the government take over and tax you whatever they feel they need from you. That's not a good plan. Right now, you can control your tax rates. Once you're on the government plan, it's out of your hands. It's out of control. And that's a dangerous situation. So you want your plan, not the government plan. You want to be proactive right now. That's why listening to Brad here and getting some of your affairs in order here, especially if you're in retirement or you're heading there, you're in your 60s, that's probably the sweet spot where you can move a lot of your IRAs around, do Roth conversions, use life insurance. Not that you can't do it once RMDs kick in, required minimum distributions at age 73, but then you're limited because you're forced, that's part of the government plan, part of that broken promise I talk about, you're forced to take that money out whether you want to or not. Now it's out of your control. Right now, you can control your tax rates, your brackets, and take advantage of these 12%, 22, 24% brackets. People think, Brad, that taxes are always high. It could be 1%. They say, well, it could have been zero.
Right, right.
But if you look at page 28, something I always go to here in the book, you'll see a history of tax rates. I put this in so you could see how good you have it now. These are the good old days. I do the complete history of tax rates from the 16th Amendment. This is on page 28 when you get the book, just to sober you up on how bad it was and could be again if you believe in math like me. From 1913 to right now in 24, the top federal rates. So I highlighted, you'll see in the book, certain years, the years me and many of you watching or listening were born, the baby boomer years. These are the people coming into retirement and transferring the wealth at some point. So those years that the baby boomers were born, which I have highlighted here, 1946 through 1964. If you look at this chart, you'll see the top federal tax rate for each of those years exceeded 90. I should write it out because when I say it, I think I heard him say 90. It can't be right.
Yeah.
90% exceeded 90% every one of those years, except the last year, 1964. I was only 10, so I wasn't really into that yet. I was watching the Beatles on Ed Sullivan then, but I was told in 1964, maybe that's why they lowered the rates. They lowered the top rate, which was went from 91% all the way down to only 77%. And I'm told the whole country did a happy dance. Only 77% taxes. What a deal. That's more than double what we're paying now. These are the good old days. Now is the time to strike. The key to all good tax planning, which in English means keeping more of your hard-earned money, is to always get the money out, pay taxes at the lowest rates, which may be right now. And the reason I give you the history is to show you how bad it could be. It was Mark Twain that said history doesn't repeat itself, but it rhymes. Or another way to look at it, those who don't learn from history, the rest are bound to repeat it.
Doomed to repeat
right
it.
now, you have this window. You have Brad, one of the top advisors in the country, because he has invested in his education on tax planning to learn this so he could save his clients a fortune in taxes. which is where you should be going. It's okay that you have, even if you had another advisor to help you make all the money, it's what you keep that counts. It's what you keep. It's the score at the end of the game. In sports, that's all that matters. Who won in overtime?
That's it. And we're going to be talking about that on the rest of the show today. And I'll say this, my father was a great gift to me. And in the book on page 28, as Ed was saying, you've got this tax chart, and I keep it in every single office, laminated in my office, in the conference room, every office in here, because I want everyone to remember something. The year my father was born, on that same chart that Ed's talking about, it was 1944. And in 1944, it wasn't 91%, it was 94%, the highest federal tax bracket. And so, people forget this. I'll always ask people when they come in to meet, I'll say, do you remember what Ronald Reagan did before he was president? And most of them are like, no, depending on their age. Some will say, well, wasn't he an actor? Yeah. And you know what? When he was an actor, he was on the record for saying, I'll never make more than 2 movies in a year. And
Right.
people think, well, why wouldn't he do that? Well, look at what the federal tax rates were. If you were living in California and making millions of dollars, why would you work yourself to death when you're giving 94% of it back or 91% back to the federal government? You're not keeping anything. So it's not what you make, it's what you keep after taxes that counts. And that's why you need resources like this. You need to make sure, just go to Amazon, pre-order the book. It'll be available after June the 11th. The Retirement Savings Time Bomb Ticks Louder. And if you want to meet with a qualified professional, both my son and I are retirement income certified professionals, and I've been training under Ed for 15 years now. Our number is 866-780-7233, and we'll be right back after this break. Friends, on today's show, we're talking with America's IRA expert, Ed Slott. We're talking about his brand new book, The Retirement Savings Time Bomb Ticks Louder, how to avoid unnecessary tax landmines, diffuse the latest threats to your retirement savings, and how to ignite your financial freedom. Now, that's a topic I love, Ed, so I want to spend some time on this. True financial freedom. A lot of times on the show, I will use 2 millionaires as an example. Someone who has $1 million and thinks they're a millionaire because it's in a tax-deferred account, and someone who has $1 million in a Roth IRA. And I just do a little example showing how the $1 million in the tax-deferred account is not really a millionaire. If you don't believe me, just try taking all of it out and putting it in your bank account. So let's talk about this for a minute. In the book, you mentioned Congress's single best gift. What is that?
The Roth IRA. I'm a big Roth fan because I love tax-free. And in my programs, as you know, Brad, I talk about my always rule. And the reason I do that, I have several always rules, things that are always true. And the reason I started doing that years ago is I would go on TV and they have all these financial pundits, and they were all so wishy-washy. Would never give you, not me, I never did that, but they didn't want to bother anybody or give, all this wishy-washy advice. They would say, well, maybe, could be, probably, generally, it depends, who knows, what kind of advice is that? So I've created in my programs my always rules, things that are non-negotiable. You can take it to the bank and they're always true. And they're so simple and they're the best concepts to understand. So my number one always rule, which you just hit on, is tax-free is always better. Tax-free is always better. You will always keep more of your hard-earned money. I mean, It's so obvious to me.
Yeah. Well, it seems like, I don't know, I've never thought of this example before, but it's almost like going shopping and you walk through the store and you're picking out all the things you like and you pick out 10 things. And then when you get up to checkout time, when it's time to pay the bill, the person at the register says, hey, do you like what you got today? Yeah. Now go put 5 of those back because you don't get to keep them. It's almost like, but wait, I put all of them in my possession. I've got them. They're mine. No, you gotta pay the tax. You gotta give half of it back. So we would rather go shopping in a store where we get to pick out what we want and keep everything, right? It's all ours.
Look, I say this in all my programs and you've heard it, but in case you haven't heard it, this all started when we started school. I started in kindergarten at my age. Now as a grandparent, you might, when I had a new grandchild too, same time as you, May 14th.
Wow.
As any grandparent knows, now they have like, I started at age 5. It was called kindergarten. That's when I started school. But
Right.
now you can go to, there's like 10 levels below that. As a
There is.
grandparent, you can go to 10 graduations before the kid turns 3 years old. Oh, great. You give them graduation. I see lawn signs out there. My daughter, graduated, 2-year-old, a 3-year, or mommy and me, or whatever it is.
Pre-K.
Yeah. I
Yeah.
know it's crazy. But anyway, when I went to kindergarten, believe this whole business started with things that we learned that were wrong, like sharing. Now, you may say, well, Ed, sharing is good. It's good for your toys, your crayons, and your snacks, but not your money, especially when you don't have to. And that's my
Right.
whole point. People overshare. You know how they say online, TMI, too much information,
Right.
oversharing.
Right.
That's one issue. All right, that's a personal thing. I was going to say maybe that doesn't cost you money, but it costs you, I don't know, other things, too
Yeah.
much sharing.
Yeah.
But
Could
too much
cost you half of
sharing,
everything.
what's that?
It said it could cost you half of everything, depending. Yeah.
Good one. I have to use that one. Yeah.
Yeah.
But when you give too much sharing of your money, you're not getting it back.
That's right. That's right. Well, you said earlier in the show, and actually, I had this written down for us to talk about today because I actually went on one of my favorite websites, and I know you don't need to look at it every day or you'll be depressed, but this website reminds me of the Energizer Bunny commercials.
All
That's
right.
always going around, boom, 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 and that's usdebtclock.org.
Right.
And I opened it last night to watch the dial spin, and we're at, just like you said, 34.7 trillion. By the time people watch this, it could be $35 trillion. And I heard this week. I know that the numbers are going to change a little bit, but I believe Tom Hegna said it's growing by $1 trillion every 100 days.
Gosh.
That's
What is
mind
that
blowing.
anyway? Like, I
Yeah.
thought a million was a lot. Then we were told a billion is a lot. A
Yeah.
trillion? I don't even know how many zeros. Like, but the point is, that's an unpaid bill.
Hmm.
The
That's right.
way our government works now, imagine, this is how Congress works. Imagine you go to a nice restaurant right by you in that place I like, Hemingway's.
Yes.
What's the Bass?
In
What's
Bass Pro,
Yeah.
Hemingway's in Bass
So
Pro. Yeah.
you go through the incredible museum, and believe it or not, I'm not saying that. I mean, when we were planning to go there, and you said to my partner Laura, you said, "Oh, he should come." Hey, Ed doesn't go to museums, boring.
He won't like that.
I spent
Yeah.
the whole day there, and then I ate 2 meals there at Hemingway. So anyway, let's say you go, you're by Brad over there. Is that also in Springfield, Hemingway?
It is.
Yeah,
It's in
yeah.
Springfield also.
Yeah, I get confused with Springfield because of The Simpsons. You never know where Springfield is, right?
That's right. That's right.
So
That's right.
anyway, let's say you take your family. I'm explaining how Congress works with money.
Yeah.
Imagine if this is your family. So you have a nice family outing. You're going to Hemingway's over there. We should get some back from Hemingway's, by the way, for this, Brad. Let that guy know.
That's right. That's right.
So you're
Johnny
going
Morris, are you
over there.
listening?
Yeah, you're going over there, you have a nice meal, you have the whole family around, everybody's ordering all these great meals there. And then they bring you the check at the end. That's the way it works, most places. They bring you the check. How would it be if you had a meeting with your family whether we're going to decide to pay the check or not? That's exactly how Congress figures out the budget. Are
Mm,
we going to pay it, or we're just going to raise the debt?
just raise the debt ceiling. Yeah.
We don't have that option. We can't walk out of Hemingway's and said, we had a meeting. We'll catch you later. Okay.
Right.
Just put it on the tab.
Very good. That's good. And Ed, just since we've been talking about Ross and Congress's single greatest gift.
Oh, right. That's where I lead. So I love tax-free because you get the tax man out of there because it's going to grow. The minute you move to tax-free territory, the sharing stops. That's where we were going with the sharing. I said I wasn't a good sharer, right? Because I learned my lesson. I was okay with the toys and the crayons and snacks, but I learned about the money later. Once you move, what I always say, from accounts that are forever taxed to never taxed, from taxable to tax-free, and you see your money grow, and you know it's 100% for you and your
Mm,
family, your beneficiaries beyond, that's a pretty good feeling when you make money and you don't have to share because you have tax freedom. You paid for that right by converting to a Roth. Yes, that costs some money now, but you
yeah.
can get that money out when taxes are on sale at rock bottom prices now. So you get it to the Roth. And then I call that account the Congress's best gift. They gave us a gift, and they gave us a gift, luckily for us, because luckily for us, Congress are the worst financial planners on earth. The only
Yes.
reason they gave us that gift is because they, as usual, needed money. And somebody said, oh, you know what? Roth IRAs bring in money. If we just let people grow tax free forever, they'll give us the money up front. And of
Right.
course, they're short sighted because if everybody did this, there'd never be any tax revenue on the back end, but they keep kicking the can down the road. They only look at what comes in up front. Why don't we take advantage of their short sightedness and let's look at the long view? Yes, we'll pay them a couple of cents on the dollar up front, but then all the reaps and the reaping, the rewarding, all the spoils go to you tax free, where you don't have to share a dime with anybody, with the government anymore. I love that feeling. And of
Mhm.
all the people I encouraged to do Ross, like I did myself since 1998 when they came out, I'm thinking back, I never had one complaint about somebody paying the tax that has a Roth. It's the other way. I've had people write me letters. Some of my old clients, they still write handwritten letters. It's nice to see. And they said, this is the best thing I ever did. My Roth, especially the ones who listen to me. You know, not all of them did. That's why I'm
Yeah.
preaching to the choir here. I'm hoping you hear it. Uh, the ones that did say, "Oh, I can't believe it. I have 1 million, 2 million, 4 million in my Roth IRA. It's all tax free. Is this even? This is unbelievable. This is the best thing I ever did." Nobody talks about the maybe a few, maybe 100,000 or 20 or 50, whatever it is, to have millions growing tax free. Think about it long term. I never had anybody focus on the tax they paid up front, but I had everybody tell me how thrilled they are to see their statements, knowing it's all tax free. And that's why I wrote a whole chapter on it in this book. The Retirement Savings Time Bomb ticks louder. I'm covering it up, but that's the book. And
That's
as
it.
Brad said, the chapter in there, I call it Congress's greatest gift.
Absolutely. And that's what we want for you. If you're listening right now, or if you're watching online, because you can watch this, just go to YouTube. And here's the thing: we want financial freedom for you. And true freedom is, like Ed said, looking at your account and knowing that every penny of that is yours. It's not going to affect your Social Security taxation. It's not going to affect your Medicare premium. It's not going to affect your federal or state taxation. And so if
And
you
you
want
know
to find
what
out
else
more,
it won't affect? It
what's
won't
that?
affect your beneficiaries.
Oh, 100%. You're passing on true freedom. So that's why you need a copy of this book. Go to Amazon, pre-order it. If it's after June the 11th, you can go on and order it. But here's the thing. Our number is 866-780-SAFE. That's 866-780-7233. Call us anytime. We'll connect you to the key information that you need to know to protect yourself from unnecessary taxes and fees. So we're going to be back with one more episode with Ed to kind of wrap this up, and there's a lot to cover, so stay with us. Okay, Ed, we've been talking about your brand new book, The Retirement Savings Time Bomb, ticks louder, and I have like 10 things I want to cover. So
Well,
I
I would
want to, I
like to
want to,
say, why, you see the cover of the book here? Why
yeah.
is louder such a big word there?
Mm,
It's in caps, it's in yellow, ticks louder because I'm worried about that ticking tax time bomb going
yeah.
off at the absolute worst time for you in retirement when you want to have an idea of what taxes are going to do to your standard of living. You won't know that if the rates go up and they get jacked up and you have maybe a fixed plan or budget. That's not going to help you.
Not at all. And boy, that just made me think about something, Ed. You know, when someone pulls the pin and they throw the grenade, everyone's worried about when's the grenade going to go off, and you don't know. You know it's
Oh, I
going
hate
to.
to say it, but the pin has been pulled. It's
It's
just
been
a matter of,
pulled.
we already know in 2026, if the Congress does nothing, rates will be higher. But I'm also
That's it.
worried about Congress addressing the debt. I got to believe they're
Yeah.
going to do at some point. And you don't want to be the one stuck when the music stops with an IRA or a 401k. Yes, I'm like Mr. IRA. I was studying and training on IRAs for my whole professional career. But now it's a bad account. We have to do something about it because it's not invested, it's infested with
Ooh,
taxes.
that's
Gotta
good.
call the exterminator here.
Yeah, absolutely. And that's what we help people do. There's a couple of different ways. Yesterday, I spent an hour working with a couple on the difference between how to get money into a Roth. And they were talking about conversions and contributions, and they couldn't get it straight in their head, the difference between the two. And, so let's take this example. They're 50-year-olds, 51 and 49. They have $500,000 in their 401k, which is great. But Uncle Sam owns a large portion of that, and we don't know how much until they retire and start taking distributions. And so we said, look, there's a way to convert it and pay the tax now and get rid of it. There's also this other option that a lot of people don't realize. If you have a traditional 401 right now, there is most definitely a Roth 401k option at work, and you
Right.
could simply stop your contributions into the government plan, the tax deferred plan, and just start making your contributions into the Roth 401 and build it tax free from here on out. That's another way to do it. So we want you to be proactive, whether it's making Roth 401k contributions, Roth IRA contributions, doing conversions, but that's all covered in the book. It talks about all the different options that are there. And Ed, since we're on the back nine of this show, let me tell you, or let me ask you this: why is it that you suggest that people need to be focused on the back nine?
Because that's where the game is won. It's like a football game. I always say in football, there's the old saying, the score at halftime is irrelevant. Give me the score at the end of the game, and then I'll tell you who won. In the book,
Yeah,
I use the front nine and the back nine, but it's the same thing. Uh, how many football games and college games are won or lost in the last 5 seconds? You ever notice
yeah,
that? They kick a field goal or they miss a field goal. It changes everything at the last minute. You could have done everything right for 59 minutes and 45 seconds out of 60 minutes. But at the end of the game, you blew it because you
yeah.
missed one key item. And the key item here is managing the taxes. That's going to hit at the end after you did all the hard work, the building, the saving, the sacrifice. Think of everything you had to do. Look at your retirement account. Maybe it's a 401k at work. And I've had clients come back and they show me, Ed, I don't know how this happened. I have 400,000 in my 401k. I'm just a regular worker. I guess it's just years of savings. They're even shocked. But then the reason they're seeing me and seeing you, Brad, is because I think they know they have a tax problem, and that ticking tax time bomb is going to go off at some
It
point.
is.
And proactive people want to do something about it now while you can get your plan, not the government plan. You want to control your own tax rates.
100%. And friends, there's something really awesome. There's a lot of awesome things in the book, but here's one of the things that I want to share with you why you want to get it. At the very beginning, in the first couple of chapters, Ed has a test your risk
Oh, yeah.
IQ, and I love it.
Yeah,
He
don't
actually
take
have
that test. It's too depressing.
but you need to, because I know I look at my board just from this last month and I go tax deferred, tax deferred, tax deferred, tax deferred, too much money in tax deferred accounts. So it'll let you take a test your risk IQ. It's going to help you put together a complete plan. You need to work with retirement income certified professionals to help you put the whole plan together. And that's exactly what we do here. But I want to say this: if you're watching online and you're like, well, Brad, how did you get a copy of a book that's not out yet? Because my great friend Ed and the team there, they gave this to us at a conference. I even have, as you can see, a signed copy. But I want to tell you, my greatest regret in life, I sat on the front row at all the
That's
conferences.
right.
They hand the books up. We took a big group picture, and I was like so mesmerized. And I can't believe they pulled this off. They got us a copy of Ed's book before it's even out. I've got it before everyone. And a guy who was on top of it, which is why I want to end the show this way. He was thinking, he rushed up front, and I wasn't worried about it. I knew Ed was going to sign my book. He rushed up there, and he was in front of me,
Oh,
and he said, I want to be the first person to have you sign your new book. And I thought, why didn't I think of that? So guess what, everyone watching all across the world, I'm the second person that got Ed to sign the book, but I could have been the first. And here's the whole thing. You don't want to finish second, because what's second? Everyone says it. It's the first place loser. Okay. Make sure you finish first. And how do you finish first in retirement planning? No information that no one else knows. Keep all of the money that you save for retirement. Keep it all tax-free. Can do conversions, contribute to Roths. Make sure, like the book says, ignite true financial freedom. And how do you do that? By making sure everything that you've saved is for your use and for your family's use. So, Ed, anything else you want to share with us about your brand new book?
Think about it this way, like you were talking about. I always put it this way. Your money in a 401k and IRA, and that's where most people have their money, because that's just the way the deal was when 401ks came out and IRAs came out. IRAs turned 50 this year under ERISA,
Wow.
Labor Day 1974. But so you look at your money and it's compounding. The market goes up. Oh, that's good. And it is good. But it's compounding not 100% for you. It may only be compounding 50% for you. Because every time you make a contribution or your balance goes up and you look at it, it's also going up for the tax man, for Uncle Sam. The great thing that you can do by using the principles and having an advisor like Brad that knows this, imagine if the compounding was working for you rather than against you. The compounding in your current retirement account is working against you. Yes, it's math, but the principles apply whether it's working for the government or working for you. How great would you feel if all that accumulation and compounding is working in your favor and not the government's favor? It's like they say, you want to have more. You want to have things working for you, not against you, because there's no in between. If it's not working 100% for you, it's working maybe 50% against you.
So let's set things up for you as a consumer, those of you who are saving for your retirement, or maybe you're already in retirement, where you're in math class where instead of there being addition and subtraction, I made this. Oh, but you got to give this back. Well, then I made this. Oh, but you got to give that back. Let's have it where it's just addition, right? You put the money in, you make it, you compound it, you keep all of it. The only subtraction is going to be when you take it out and you get to use it however you want to and leave Uncle Sam on the bench. That's what we're specialists at. That's what we will show you how to do. Keep more of your hard-earned money in your own pocket. So make sure that you order a copy of the Retirement Savings Time Bomb Ticks Louder by Ed Slott, America's IRA expert. You can order it online on Amazon, pre-order before June 11th, or it'll be available anytime after the 11th, and it will transform your retirement savings. I can guarantee you this.
I'll leave you with one thing, Brad.
Yeah.
I know one thing you do for your clients, because we bang it home, check beneficiary forms. I want to ask you, as an advisor, when the people you ask your clients, who do you want as beneficiary, how many people say, put Uncle Sam on there? Has anybody
Zero.
ever said that?
No one has
But
ever.
they all have him.
They do.
He doesn't even have to be on the beneficiary form, but he's there.
Yeah.
Unless you do something about it.
That's a great thing. I think in the beginning of setting up every account from now on, when they say, let's say this would be a great example. We've got 3 kids. We want, everyone says 33 and a third, 33. And it's like, well, that doesn't add up to 100. It's got to, I always say, which child do you love more? Give them 34 and the other 2, 33. That adds up to 100. But from now on, I'm going to change it. I'm going to say, I think you mean it needs to be at least 25, 25, 25, 25. Because Uncle Sam is at least a fourth, but he might be a half. He might be more. We don't know yet.
In almost every case, he's going to be the biggest beneficiary unless you take action to remove that beneficiary.
That is so good. Say that one more time. If you're listening right now,
almost every case, if you have a taxable IRA, a 401k, no matter what your beneficiary form says, in almost every case, Uncle Sam will be your largest beneficiary without having him even named on the form. That's just by default, by you doing nothing, by you having the government plan. Get your plan, not the government plan. Take Uncle Sam off as the beneficiary, and your family and you will always have more.
Friends, call us anytime, 866-780-SAFE, 866-780-7233, and order your copy of Ed's new book today. Ed, thank you so much for joining us.
Well, I'm proud to be on your show and in your town because you're doing right by your customers there, by your clients, and by your investment in educating yourself far beyond the average advisor. And everybody who works with you has to benefit from that. So thank you for doing what you're doing.
Thank you. And I just found out today, so when you order your book, turn to page 406. We're mentioned in Ed's book. Ed, thank you so much. You guys have a fantastic day. We'll see you again soon on Safe Money Radio. Have a fantastic week.